It's Friday, and you are live with Sonoma Wealth Advisors, and we are about to go on the market. What happened in the market this week? Was it the tariffs? Was it everything that was already in place, anyways, and tariffs were just the match? We're going to find out if in a bear market, a balanced portfolio makes sense. We've got some new job numbers to look at. There's a spike this week that no one was talking about. And we're going to see if gold's run is actually done. My name is Dan Weir. I'm joined by Daren Blonski and Chris Sipes, and we're going to hear from them after this. Alrighty, as I said, I'm Dan Weir. I'm the marketing director for Sonoma Wealth Advisors. Daren Blonski, Chris Sipes, co-founders of our firm. And Daren, this is something you've been talking about for a number of weeks, which is that, yes, tariffs are a very convenient storyline for why things may be changing in the economy, but you've been saying for weeks that perhaps we've been building the kindling for this fire for a long time.
That's right. I mean, I think we're long in the tooth. We have been long in the tooth economically. We saw a lot of things happening last year where it was really obvious that every trigger and lever that was being pulled or pushed, or however you want to phrase it, was being utilized. And I think we're finally at that point where it kind of gets to this point, and I imagine it like trying to balance a bunch of plates on your hand and your head and your foot and your knee, and then you throw a shock in like the tariffs, and it just pushes it where it was already headed anyway. Now, that doesn't mean that the current administration won't start doing the same stuff and printing money and stimulating, and we're certainly starting to see signs of life in the market. And we have moved to that exact point we talked about last week, where this is the point of decision, right? So that 61.8 Fibonacci line on the SPY. And this is that point where we tend to see things go back down if they're gonna. If we move through this line, the probabilities are now to the upside that we attack all-time highs, which I know is absolutely shocking that I'm sitting here telling you that we are on the cusp of exploring the idea that the market might be moving to all-time highs. Pretty wild. Just the narrative back in, just the early part of April was that the world was ending and things were over. And in fact, April 7th was the bottom.
Well, speaking of the world ending, Chris, you were out on assignment last week, and you had this meme in there. We're going 2 for 2 weeks in a row with this meme because I love it so much. I wanted to give you an opportunity. I busted this out last week because I loved it so much, but it's appropriate. Good. It's appropriate because April 7th did feel like the meteor was coming towards Earth. And, which one are we going to be right now? Are we going to be the dinosaurs? Are we going to be the humans? I mean, who is... we're kind of in that scenario right now where it feels, is it cataclysmic?
Right. Well, I think this could be one explanation, because if you look at the market, basically it finished up April, and I'm talking about the S&P 500, it finished up April down like 1%. So essentially flat. Had you looked at the market at the beginning of April, woke up and checked it again at the end of April and just missed the whole narrative of what happened in between for the month, you would have thought nothing really happened. And at least that's what the market is saying right now. And count me confused, but the market is, at least right now, is basically saying, hey, these tariffs are a non-issue. So I don't know if that's because we're all expecting it to get rolled back quickly. Expectations around, the exceptions are changing. Whatever it is, the market seems to be looking past these tariffs as another one of those. No big deal. We've got another 2-week, panic drop, and then we're back to, as Daren said, all-time highs soon, which could be very confusing, but I wouldn't be surprised if that type of situation could happen. And, been watching the markets long enough to know when you feel confused and you think the market's wrong, you're probably wrong. The market's probably hitting it correctly for whatever reason. So I'm going to go ahead and go with the market and assume that, the worst is behind us.
Well, Chris, what I'm going to do is I'm just going to look to a major market publication and take their advice that, okay, I should just put everything in gold.
Well, I'll put this in here because of the dreaded magazine cover indicator, right? Which is, as soon as you see it on the magazines, it's time to fade it, get out of whatever it is, because by the time it's on the magazine covers, it's too late. Everybody already knows about it, and it's probably going to change. Dan, you've been on when we've talked about how that happens with the EA Sports covers, right?
Yes.
So now, in fairness, I did not read this article. I'm not a subscriber to Barron's, but I understand the article was actually bearish on gold for what it's worth. But, it's on the magazine cover. I'd say anecdotally getting questions about gold in a positive way from clients like, hey, how do I buy gold? Oh, I already have it. I didn't know that. Right. That's great. Wow. Perfect. A lot of people are starting to ask about it, which to me is another sign of like, oh boy, maybe we have reached the end of this parabolic rise in gold. Maybe not, but it's people are starting to talk about it, which was not the case 6 months ago. Nobody was asking, nobody was talking about it. Nobody knew that gold was in quite the bull market.
And to clarify what Chris is talking about, EA Sports is a video game company. They make a game called Madden, named after John Madden, and they put a famous player, like the best player of last year, on the cover of the game. This past year was actually Christian McCaffrey, the running back for the 49ers. But there's what's called the Madden curse, which is that as soon as you get on that cover, and it happened to Christian McCaffrey, you have a terrible year. He blew up his knee. He barely played. So Barron's and Madden are very close.
Yes. Yeah. So you don't want to end up on a magazine cover. So now this is a very busy chart, and this is from UBS by way of Meb Faber, and UBS had an article on how to, look at a bear market. Now, I think that this market's really given us all a huge gift here at the beginning of May, which is if you were someone that was panicking in April because you felt like your portfolio was a little too high speed for you. Hey, we're kind of back to where we were at the beginning of April. And so you might think about downshifting, right? If you were someone that was like, boy, this is just too much. Maybe you're in a portfolio that's a little too racy for you. And now you've been given the gift of, okay, you can reassess. Let's reassess and get your portfolio created, because I think it's easy to forget, especially at the end of a long bull market like we've been in, and especially the recent ones that we've been in, where we get a drop and it's all fixed within a couple of weeks, right? Whether you're talking COVID, whether you're talking this most recent panic, guys, that's not normal for the market, and that's what this is showing. That going back to 1945, so post-World War II era, U.S. large cap stocks, the average drop in a bear market has been, the max drawdown on average, max drawdown was 30%. The one we just went through was what? 17, 18%, something around there. So not even close to the average drawdown. Now that's not the worst. There's been much worse. In 2008, we got down 50%. But then you go down there to the bottom, even a 60-40, quote unquote balanced. Now, I would argue that is not exactly balanced. It's just stocks and nominal bonds. And for most people, it's actually just U.S. stocks and nominal bonds. So it's really not as diversified as you might think. Even there, the average drawdown in a bear market is 18%, which is fairly severe. So, and then you look at the time to full recovery. On average for stocks, it's been just shy of 3 years. And for the 60/40 portfolio, it's just shy of 2.5 years. And so normally when you see a drop in a portfolio, it can be more severe and it can take longer to get back to even. So, like I said, think back a month ago. How were you feeling? Were you panicking? Were you really feeling like I'm taking on way too much risk? Well, now's the time. Now that we're kind of back to even here and you're in a little bit calmer of a headspace, make the changes so that you're not panic selling in the future. All right, we got the AAII sentiment indicator. Again, bearishness close to 60%. So people are still feeling fairly pessimistic. What's interesting, though, is you just didn't see a lot of the selling this time. So going back to the dinosaur meme, people were like, I'm so bearish, I'm just going to buy, right? And we've all been kind of trained like Pavlov's dogs that when the market goes down, it's time to buy, right? Because it's not long before the Fed or the government or both come in and bail us all out and bail the market out. And so usually, and at least so far with this sell-off, it's been the same thing. Hey, the sell-off was a buying opportunity. And so people are still very bearish. The CNN Fear and Greed Index is all the way up to 42. That's on how people are actually positioned. So 42, which is still in the fear zone, but way off the lows of a 4 that we measured a few weeks ago. And it's up from a 35 fear last week. So getting closer to the neutral zone. Bitcoin, we've got up to 67 greed, which is up from 60 last week. And Bitcoin's been on a bit of a run. And, it fulfilled, I think it's positioned this sell-off as a telltale of what was happening. It was the first to sell off in the panic sell, and it was the first to recover as we've come out of it. So again, Bitcoin to me just is showing the tip of the spear when it comes to risk and liquidity and everything else.
Hold on, Chris. Give him a chance. He's going to unmute his microphone. He's going to say something.
I'm resisting the temptation to
trying to trigger
on Bitcoin.
Yeah. Well, hey, speaking of triggers, treasuries, this I thought was interesting because it's completely counter narrative what we heard just a few weeks ago that everybody was selling the treasuries. Nobody wanted to hold U.S. debt, et cetera, et cetera, et cetera. And it turns out that according to Bank of America, the flows to treasuries were epic during that time, the highest inflow that they've seen since March of 23, which I believe was the Silicon Valley Bank sell-off. So still providing that safe haven status in the storm, which is obviously a good thing to see as an asset allocator.
For people who don't know, treasuries, these are bonds?
Yes, there's treasury bills, they're short term, there's bonds, there's notes, short, medium, and longer term, but they're issued by the U.S. government. So they're a debt of the U.S. federal government, and they've always been considered a safe haven in the past because of the U.S. The strength of the U.S. economy, the strength of the U.S. military, and our credit rating. Basically, the U.S. has always paid their debts, and so it's always been a safe haven asset in the past. And but there's a lot of chatter about that not being the case just a few weeks ago.
So you've got many things on the table, but if we're going to be really general for a lot of our conversations, it seems like some of the players are, you've got the market, stocks, you've got bonds, and then you've got, at least for right now, gold. And we had, during this April panic, you had stocks down, bonds down, gold up. Now you're seeing gold down a little bit, bonds up, stocks a little bit even. Am I off there, or is that kind of how the calculus is kind of balancing?
Well, yeah, stocks have been even in the sense that they've come off their lows, though, dramatically. Basically, the day that they paused the tariffs, since then, the market has just been on quite the tear. And that's both domestic stocks and global. And again, global leading the charge out of that bottom. So we might still be seeing that rotation where, the foreign stocks are going to start to cycle in a little bit here. It's less than 6 months into the year, so it's too early to tell, but so far that's been the case. Now, this is where I get confused because with all the tariffs, the structural changes, we're basically, proposing making changes to the global trade system. Obviously, there's all this news about shipping containers not showing up, and all the orders that need to be in before Christmas, for Christmas need to be in now, and that none of those orders are being made, and prohibitive tariffs on China, especially. But yet the market's like, nah, no big deal. It's not a problem, right? And maybe this is why. This is from Torsten Slok at Apollo. And, there's been a few meetings between the administration and leaders of some of the large U.S. companies, which, they're probably saying, hey, we're on board for this whole, reshoring things to the U.S., but you got to give us some time, man. And 90 days is not going to be long enough. And there's a lot at stake, right? Because if you look at the revenues of the S&P 500 from China, are significant. Some of our biggest companies derive a lot of revenue from China, and even more so, some of them derive, a lot of their products from China. Apple probably being the best example of that. And so you get all these articles coming out about, an iPhone is going to cost $4,000, right? People are $3,000, whatever the number is. It's like prohibitively expensive. It's just not going to happen. And so there's a lot of exposure. And I think the U.S. companies are going to the administration and saying, look, this, we got to have a plan that's going to give us more time to adapt to this new structure. And it looks like, according to the market, they're getting what they want. Now, I can't speak for the small companies. There's probably no exemptions for, the little companies that don't have lobbying dollars. They don't have stock prices that are correlated to people's 401ks and such. They're probably just out of luck. But the larger companies have a lot of pull in terms of their say in what's going to happen moving forward.
And just as an example of how pervasive the Chinese influence is, not a political statement, I'm just giving an example. The one that everyone is focusing on is tech. They're focusing on the TVs and they're focusing on the iPhones. I was giving my son a juice box this week, and it's a major known juice brand that all of us drank as kids. And I just happened to see, like, printed in the most dot matrix font, apples sourced from China. And I was just like, it's so it is not just your television, and it's not just your Apple Watch. It is across many, many, many sectors that are being impacted by this.
Absolutely. Yeah. It's a very tangled web. Now, we got the durable goods numbers. Now, durable goods, you would think like cars, refrigerators, ovens, things that you buy that are going to cost you quite a bit, but they're going to be durable. There's something you use over many years. It's not something, it's not your son's juice box, right? And wow, look at that spike that we got this month. U.S. durable goods new orders month over month is at 9.2% compared to 0.83 last month, so less than 1%, and 0.8 last year. It's higher than the long-term average of 0.35. So that tells you that people were front-running getting these goods in prior to the tariffs taking effect. Like, let's stock up. Let's try to ride this storm out, and hope for some relief on the tariffs before they get there. Now, I was telling Daren that we were looking at getting some air conditioning installed, and the HVAC contractor just threw it out there. Hey, so I won't. Well, actually, I should name the company. I don't want to get sued. But this company that provides air conditioning equipment just raised their prices on pretty much everything 30% due to the tariffs. And I'm like, hey, man, I pay attention to the markets. The tariffs haven't even kicked in yet. What are you talking about? He's
Do
like,
you know who
hey,
you're talking to? I know.
don't you watch my show? I'm offended. Yeah. But look, they had already put in place the price increases, which obviously is going to flow through the contractor, which is obviously going to flow through to me. And at least for us, we were like, well, that doesn't make any sense anymore. I'm not going to pay 30% more. It's just, I'm sure there's examples of like that, things like that all through the economy, which this week on the Animal Spirits podcast, they were talking about the whole, did you guys see the Amazon thing where they were going to put a line item for the additional cost of the tariff, so that it was like your good cost this, and then there's a line item, tariff cost this, and then your total. And they actually had a great idea. They're like, look, that's probably a smart way to do it, because then if the tariffs get removed, they can remove that line item and the price can go back down. Otherwise, you're going to get what you got during COVID, which is all these companies just raising prices, blaming it on supply chains and everything else, never lowering the prices back down. Right. So
the number of times I'll be at a unnamed grocery store and like cheese is on 50% sale, and I'll go, oh, the old price. Nice.
Yes. Yeah. So to your point, Dan, all the things that would be affected. And again, why I'm saying, hey, the market must be saying this is not going to happen, at least not in the way proposed, because look at, these everyday items that we all use and buy, the percentage of that item that is made or imported from China in some way. Right. And so if you add 150% to that cost, or whatever the tariff amount is going to be, it's a massive tax. It's going to be a massive price increase, or you're just not going to have the goods at all. That's the other thing. If it cannot be produced here, then how's that going to work? So the fact that this is so impactful, and yet the market's like, no big deal. Hopefully I'm not beating a dead horse here, but it's like, okay, something's not adding up, right? Something is not adding up. Somebody in the markets, or many people in the markets, must know what's going on behind the scenes, to say that, hey, this is just not, the storm is not going to hit us the way it looks like it might.
And I've got just that chart, Chris. I was saving it, so it's coming.
Good.
I'm going to tell you in just a minute, buddy.
Good. Now, it's not just us in the U.S. or we Americans that have to worry about the trading partner status, but China is also a trading partner for many countries. And this is from Kevin Gordon at Schwab. Of course, this chart's from the Financial Times, but he says, of the countries in this chart, 14 of the countries have larger exposure to China versus the U.S. when it comes to trade, meaning that they do more trade with China than they do with us. And so, if there's going to be hardball played, you'd think there's some leverage there as well. Like, it's mommy and daddy are fighting again. I've got to pick a side, right? I've got to pick mom or dad's side here. Well, dad's the one that gives me all the money, and so I better side with him. I get all the toys and money from dad, so I guess I'm going with dad.
Well, the U.S. sends me bombs, but China sends me stuff from Temu. Which one matters more in my country?
Yeah, it's a complex trading system, and it's not as simple, of course, as what it might sound to implement tariffs across the board. Now, what's the two-year treasury saying about interest rates. The two-year treasury in this chart is the purple line, and then you've got the Fed funds rate in orange. And you can see that they tend to follow one another. And there's a lot of market commentators that would say, hey, we don't even really need a central bank to set interest rates, the Fed funds rate. They could just follow the two-year treasury. And that's the market's best guess of short-term interest rates and what it should be. And so you can see that we're a little tight now at 3.6 versus 4.5 on the Fed funds. And so would not be surprised to see a drop on the Fed funds rate. And because, I'm sure that the Fed looks at this type of information. Although after today's jobs numbers and such, it looks like there's 3 cuts priced into the market for this year instead of 4, so fewer cuts. But keep an eye on this short-term rate versus the Fed funds to kind of know where they're going with interest rates, most likely. Further signs of the markets calming down. This is the spread between high yield bonds, or think companies with poor credit, the cost that they have to pay to borrow money versus a treasury, which is the US government. And again, that's considered credit risk free for the US government. So basically what's the extra cost for a company that does not have good credit is a good way to say it. And that started to spike, but has come off of its highs, just like the volatility index. We got back down to like 22 on the VIX today. We haven't closed yet on the market, so we'll see what it ends up at. But really, these indicators of stress and panic have all but subsided at this point when you're looking at the fixed income market or the volatility index. And here's why it matters for things like mortgages, because basically all credit is kind of priced off of that treasury rate, that short-term Fed rate. That's sort of like, think of that as the hurdle rate, because if you can lend your money to them and know you're going to get your money back at a certain rate, then you're going to want a higher compensation to lend your money to anybody else, basically, including mortgages. And on top of that, you have a larger spread on mortgages right now than you have historically. You can see we kind of averaged, I would say, during most of the 2000s, we'd averaged somewhere around like 1.5%, meaning that your mortgage rate would be about 1.5% above the 10-year treasury. But now that number is more like 2.5%. And so the kind of the crazier the markets are, the higher that spread, the more mortgage money is going to cost you if you're going to go borrow to buy a house.
So they're basically doing less loans, so they're trying to make more per loan.
That's one way to look at it. Yeah. I've heard from clients this week that there's several institutions that are not even offering home equity lines anymore. And then, the ones that are requesting that you go ahead and make an initial borrow. They're definitely not being as aggressive as they were previously, which I guess makes sense with houses at all-time high valuations versus income and such. They're probably just not wanting to take on a ton of risk at that level. But we got the unemployment rate numbers today. No change. We basically stayed the same. And I think this is kind of counter narrative as well, given the pessimism of people. A lot of people saying like they don't think that the job prospects are as good 6 months from now as they are today. They're worried about losing their job. We've got all the supposed cuts to the federal government, which we'll see here in a second. I think that's also a fallacy. And so, the underlying economy, at least so far in the statistical numbers, are really not showing any of those signs of stress yet. And and going to the point of, how much is going to actually be cut by DOGE. If you look at the betting markets, this is showing that the right now the highest probability of cuts from DOGE is going to be less than 50 billion. So, that's the betting market's opinion of what will end up being cut. Obviously a far cry from the 2 trillion in cuts that were thought when we started the year. So don't think that's going to happen. I'd be very, very surprised, and it looks like the betting markets agree with that.
Does this mean I'm not getting my $5,000 Doge dividend? I was promised a dividend.
Yes, I
guess not.
I wouldn't take that to your payday lender yet. Go ahead and hold off there, Dano. Now, interesting, the 1 year change in active housing inventory for sale. So darker means more inventory is coming up. And so this is from Resi Club. It goes by Resi Club. So why does this matter? Well, it matters for housing prices. We talked a few weeks ago about Zillow saying that they expect about a 1% drop nationwide in home prices this year. And of course, real estate's very local, so that's going to be, more so in certain areas. I would guess more so in these darker areas where there's more inventory. The old supply and demand. The more supply that you have, the lower the price. So, a lot of the states that had some of the highest home price appreciation are showing up here in the a little bit darker area. But you notice not much of the map is light. So it seems like there's finally some loosening up happening in the residential real estate market, which is also reflected here in the month supply. Now, the orange line is the new homes, so new construction versus existing home supply in the purple. Now, the purple, the numbers only go back to, I think, 98, so we don't have as long of a data set. But you'll notice that up until the pandemic, those months supply really kind of mirrored one another. And then with the changes that we got in COVID and the low interest rates, and a lot of homeowners locked in probably generational lows in mortgages, that just absolutely locked up the existing home market. And then you see the separation go from there, where the new homes, we've got 7 months supply, which has actually come down quite a bit off of its highs, while the existing homes are starting to loosen up just a bit, still low relative to the historical values, but getting closer to normal. Now, from what I understand, under 3 months is very tight supply, likely to lead to higher prices. Between 3 and 9 months is kind of stasis in pricing. And then over that 9 months is considered to be excess supply and will likely lead to lower prices. So when you take kind of an average of these two, you're probably in the, hey, prices are going to be pretty flat and stable range based on this supply projection. And then this is new houses for sale, median number of months on the market. So how long is it taking to sell those new houses? Again, ticked up a bit from that extreme stress that we saw coming out of COVID, but really just returning to, I would say, would be pretty normal levels in terms of how long it takes to sell one of those properties. So I would say look for more stable home prices over the next year, flat to maybe down just a little bit based on the supply numbers here, which might be welcome news to those that are thinking about trying to get into a home, despite the fact that the prices are still very high relative to incomes.
And I think the so what here when it comes to the housing market, and on our other podcast, It's All Money, actually just had this week had a sit down with 6 realtors from Sonoma, Napa, Marin County, and you've got interest rates, you've got landlord restrictions in California, you've got a lot of things which ultimately are slowing the velocity. That's something that Daren's talked a lot about. So that maybe it's not as flippity flop, swippity swap. I put in this, I flipped a house in 2 weeks and made X, Y, and Z. It's a little bit more about, I actually wanting the residence instead of seeing it as just some sort of investment, some sort of flip, some sort of, quick buck, making it more difficult to get in and out of houses, perhaps providing some more stability is how I'm reading it.
Yeah, I think so. I think if you're going into it as an investment and the price appreciation is the biggest part of your equation, you might be disappointed if you're buying at this point. I would put it that way.
Daren, it's your time to shine, my friend. What do you got?
You go on mute. I think you're on mute, Daren.
Yeah. All right. So I think we have to pull up this chart, Chris, because regardless of whatever else is being said out there and what's going on politically or economically, you say, well, why is the market going up and why do things seem to be looking better? Well, guess what? Our good old friend Liquidity is back. And
looks like a Bitcoin chart.
It does look like a Bitcoin chart. Sadly, this is just M2. And what is M2? Well, it's the money supply. So that's how much dollars are floating around out there. And you can see we've ticked up. So we started off today by saying, why tariffs are just a match. Well, what was really happening going into the basically end of last year is liquidity was drying up. It was being pulled out of the system, and now liquidity is coming back into the system. And so naturally you're seeing the market respond. So that's one argument you could make for why the market's doing what it's doing, regardless of what's going on with the tariffs. And I think that's an important indicator when it comes to understanding market dynamics and what's happening out there. With all that being said, we've had a pretty nice green environment in the markets. This is 1 week performance. It's been a good week in the markets. We've had all our big dogs actually doing quite well: Microsoft, Nvidia, Amazon, Google, Meta. Apple is struggling along a little bit here, but all in all, a positive week for the S&P 500, which is the largest U.S.-based stocks. When we look at this in a chart and we take a look a little deeper under the hood, so this is a very, very messy chart. So let me just start by cleaning it up, and then we'll add some complexity to it as we go here, because I think if we have less complexity, then it'll make some more sense. So what you're looking at the moment is the S&P 500, and the S&P 500 represents the largest 500 U.S.-based stocks. Each one of these candlesticks, we call them, represent price movement during that period of time. So we're currently looking at the daily chart, right? And so this is each day. So this is generally 6:30 a.m. Pacific to 1 o'clock Pacific. And what you can see here is that this was the bottom right here on April 7th, and we've bounced all the way up. And now we're at that point where I talked about last week. Like, this is the point. This is the point where it's either going to roll over and go down. So magically we're going to get some really negative news, and the market will say, oh, that's the reason why we're going to roll over right here and go back down. Or we really need to start thinking about all-time new highs. We are only seven, almost 8%, 7.82% off of the all-time high right now. So we're pretty close to it. We could move there very quickly. As you've seen, we've moved quickly. But now that move is over. It's either over or we're on to all-time new highs, more likely. If we confirm and we close out the market here in 14 minutes above this level, and it finishes strong, that's looking good for us going into next week. Now, there is a lot of resistance right here, right along this 575, call it, change on the SPY chart. and that's going to be resistance to this market. But I think odds are getting more and more favor that we're actually going to take a run at the all-time high. Now, if we do take a run at the all-time high, we're going to have to contend with 590 in the SPY. So maybe you see something like this and it kind of slowly trades up and then and then trades along here and builds up, then maybe goes up. I don't think it's going to happen immediately. There'll be a lot of resistance and people taking profits off of this move here if that were to happen. But it's something that's now on the table, squarely on the table. And what I would expect if this is not it, we're going to see some type of event right here next week. There'll be some, I don't know, you make it up. Pakistan bombs India or India bombs Pakistan. And then the market goes, oh, that's the reason why we're going to go down. But really, it's just it hit a really important technical level. And so the buyers start getting exhausted and the sellers step in. Where would support be? Well, right down here. I mean, we could do something like this too, very easily, and go retest this support range, which is somewhere in the 540 area. So I don't think it's over yet by any means, but we are seeing some thawing of the tariff battle happening. Now I have this big red line on here just to overemphasize it for everyone out there, but that's really been the support line we've been working through. We tested it, we moved back up. When we look at this on a monthly chart, it's a little more, let me get rid of these fib lines here. But when we look at it on the monthly chart, I mean, that bottom candle is, to me, says this month, or I guess we're 2 days into May, right? So in April, it sold all the way down to 482 and then went right back up. And that tells you there's a lot of buyers stepping in there. It tells you there's a lot of support here. It tells you a lot of support at this 481 that ended up being on the SPY chart kind of support area. When you get these long candle wicks, the market likes to work back to test them eventually. But the fact that got bought up so quickly, I think you need to be really careful about betting against this market at this juncture. Because the structure of that market very much tells me the uptrend is still intact and we just had a quick little correction and here we go again. Now, saying that doesn't mean that we might not enter into some type of recession, right? And certainly oil, I want to talk about, is screaming at us saying, hey, something's not right here. We talked about this whole area going into the end of the year, this where the supply and demand was getting tighter and tighter, and then it broke down, and we saw that broke down, and now we're going to close this week out below this really important, what was support level is becoming resistance. So I think it looks more to me like oil's headed down. I noticed that Saudi Arabia has cut their oil production quite significantly, trying to hold up the price at 58. If we do enter a recession, oil is one of those things that goes down because oil is in everything that we consume as Americans and as a general public around the world. It's a critical infrastructure or product derivative. It's a core product that has many derivatives.
Daren, this is counterintuitive to me as the average person who, if I'm just casually following the world, I know that Donald Trump gets elected president. Donald Trump has said he wants to drill, baby, drill, and he's more about oil than he would be about green initiatives. It seems like oil would be doing extremely well, and I should have bought it a month ago. So how is that narrative wrong?
Well, we actually talked exactly about this right on November 8th, right around that time. And we talked about how this idea that, oh, Trump won, so therefore I should buy a bunch of oil, and how wrong that could be. And the reason for that is if you have regulatory structures that are becoming more and more less regulated, which is what we've seen so far. If we have a pro-business environment, it's a supply and demand issue, right? All of a sudden, it's a lot easier to get supply coming out of the ground, for one. And then second, I think you've certainly seen some thawing-ish in dealing with Russia, right? It doesn't quite seem to have the powder keg that it had. And if oil coming out of Russia gets opened up to the world, that puts more supply. The interesting thing that I think gave the market some pause this week is that Trump came out and said, look, if any of you are buying any of Iranians' oil, we're going to tariff you to the moon. But it kind of fell on deaf ears because China is one of the biggest consumers of Iranian oil. So what are you going to tariff them more? Like, and we're seeing the thawing in that tariff battle happen. We're certainly seeing concessions, but I think what this speaks to overall is that you have a market that is well overdue for a recession. If we look at our not necessarily well overdue, because I don't think we can be overdue for a recession, except that recessions are a normal part of the market behavior. And I think the policymakers have tried to remove that from the market, but I don't know that that's a necessarily healthy thing, right? Like, if you think about like in a garden, right? If you have plants and they need to go into a period of dormancy. If you're growing apple trees, speaking of apples, because you talked about apples earlier, and I have lots of apple trees on my property, and so I grow apples, and they need to have a certain number of months and days where they're actually in dormancy, right? Or cold dormancy to really do well. And the economy is not really much different. Like, we, from a health perspective, need that dormancy, and there comes and goes these seasons, and we haven't allowed those seasons to really happen for a while through various economic triggers and buttons we've pushed. But this whole yield curve that has happened, where we had this inversion of the yield, and you can see below this green line is called an inversion. And every other time we've had this massive inversion like this, and then the re-inversion happened, we've entered into a recession. So I'm in the account that we're probably going to hit some type of recession. I don't know if it's depression era or what it is, but the yield curve is telling me just the steepening in the yield curve, where that always precedes a recession and has historically. So I don't know why this time would be different. With oil going down, with that happening, I think that's more likely. Now, that doesn't necessarily mean the stock market's going to go down, right? Because the powers that be can print money, print, and they just keep printing and pushing it along, right? We certainly saw that during COVID. So you have to be really careful. One thing we're keeping an eye on, though, is this 10-year government bond. And you can see we found support right here on this trend line last month. And then we're up here, kind of elevated right now. I would say this is looking like what's called a bear flag, right? So it looks to me like it's getting ready to go higher. That we're going to see higher interest rates, not lower interest rates. And this presents a particular quagmire that the Federal Reserve and the U.S. government's in, is we've seen these cracks in the dam of a potential slowing economy. And yet they can't really start lowering rates because the tariffs are technically more inflationary. I realize there's a lot of debate on that issue, but if they lower rates down, then we have raising prices, but we also have a potential recession. We call it stagflation, right? And we had that GDP number. It came out earlier in the week, said, oh, wait, things aren't as good as we thought they were. And we still have this, rat and the python analogy of like everyone trying to pre-buy ahead of the tariffs like we saw. And so once the buying's done, then what, right? So my basic look on things as we come into summertime and we kind of start seeing things slow down more. And I think things might get kind of weak going into September. And then I think October, we're going to see a lot of stimulus coming out. We're going to see the Trump administration getting ready for the reelection, and the Democrats obviously trying to undermine that. But they only really have 5 more months to really kind of get things together before they got to go back on the reelection campaign. And I think then they're going to want to stimulate the economy. Now let's talk about gold, because you mentioned gold earlier, and one of the things I've always in awe of is the serendipity of how the charts move, and they turn around at very specific times that you can kind of see coming. And at the same time, it makes perfect sense when they turn around, where they turn around, and then magically some piece of news gets extrapolated and attached to that chart. And we talked about this 3,500 being the top a few weeks ago. And sure enough, for last month, that was the top. And we've seen a sell-off in gold ever since. Now, you could also argue that the reason gold's selling off is because there's been a thawing of relational dynamics when it comes to the tariffs and China and U.S. getting along and realizing, oh, yeah, we're all buddies. And I mean, at the end of the day, the politicians only go as long as they can. And I think the bond markets this time really started screaming, and that put Trump back in his place. And the market is an incredible, if you don't like Trump, you love the market because the market will keep him in place. If you like Trump, then you like the market too because he wants to stimulate the market, right? So it was funny this week how Trump came out and said, "Oh, this is the Biden
Right.
Biden market." And like last month, it was like, "Oh, this is the Trump market." So politicians like to use, and that's not pointing fingers at Trump or in particular. He's particularly boisterous about it, but every single politician says they do what the market does. The market, and where Trump is right, he stated this week, is that the politicians inherit the economy and the market they get, and their political lifeblood is in some ways just a random luck occurrence, because the markets are going to do what the markets are going to do regardless of what lunatic we have trying to run this country, whether you think that's Biden or Trump. So that's not pointed in any one direction. But like Chris said earlier, Bitcoin has really been the front tip of the spear on risk, right? We've seen it that way. It's performed that way, came down first, and now it's bouncing, and we're seeing that move pretty strongly. We're seeing lots of strategic Bitcoin reserves getting added. I believe Arizona this week just voted to have a strategic Bitcoin reserve. We're seeing lots more corporations come on board and put some of their treasuries in Bitcoin. So, I know Bitcoin got kind of weaponized politically, right? Where it used to be this very liberal kind of like cyberpunk thing. And then in recent last 6 months, it got kind of like pulled in by the Republican Party and Trump's group. And so now like people who flavor more on the liberal side tend to push back against it and say, "Oh no, this is not good, blah, blah, blah." But I'll just say again, like the market doesn't care about any of our politics, right? Like it just doesn't. And anytime we try to project our politics onto the markets, onto any type of asset, we're making a royal mistake on our portfolio. And that's just the reality of it. And that's where it becomes so difficult to run programs like ESG or environmental social governance. Is the market is just much bigger than any of our political beliefs. And I think we're learning that as Americans, right? That the world is much bigger than any of our stances on anything. And there's a lot of people with a lot of different opinions out there. And the market I look at is this great aggregator of opinion. It brings all the opinions that are existent in the ethosphere together and then creates a price. And that's why I follow price versus trying to get too attached to whatever fundamental drivers out there. Because at the end of the day, price does what price does, and the news follows. And that's how it works. And so we're seeing Bitcoin move up. And we're getting to the point now, I think 99 is going to be resistance. If we break through 99, I think we attack all-time new highs. I think what we tend to see is these periods of time when they break out, it really breaks out. And if you go back over weeks, and you can see where it will kind of trade sideways and then it just breaks out. So if we break out here, hold on to your seatbelts, folks, because it's going to rip if it goes back into 100,000 per Bitcoin. Thing is to remember with Bitcoin is it's not like any other asset. There's a fixed supply. There's only 21 million. That's it. So the dynamics of it change really quickly. Whereas like if Apple's getting bought up, they can split the shares, they can put more shares out there. There's lots of things they can do to keep price in line. That's not true with Bitcoin. That's not true with gold. There is a fixed supply of gold and there's a fixed supply of Bitcoin. Like it, hate it, I think it's now hit the point in life where it's a reality for all of us and an accepted asset. Well, I think we're going to leave it all there for this week. Thanks for joining us, and we'll be back next week.
Thank you so much for thank you so much for checking out the show. I hope you were able to get some perspective on many different factors in both the market and the economy, which were already going anyways, whether it was the inversion of the yield curve or perhaps the activity of oil. There were already indicators that perhaps an economic slowdown was already upon us, and tariffs are just the match. Just the thing to kick off and just the narrative to say, well, here's the reason why. And the goal of our show is to look at the data objectively and try to present what we're seeing and let you draw your own conclusions. So thank you so much for checking out the show. We are Sonoma Wealth Advisors. You can learn more about us at sonomawealth.com. Take our free wealth analysis. wherever you're listening right now, whether it's on YouTube, whether it's on Apple Podcasts or Spotify, you can subscribe, and that way you won't miss future episodes. Thanks so much for checking out On the Markets.